Good afternoon. I want to thank everyone for joining us today. I am Lindsey McKay, owner and lead advisor at McKay Wealth Management. And as you can tell, I'm feeling a little under the weather. So I'm going to let most of our speaking be done by our guest today, Faith Chaffee, who is the Senior Regional Investment Specialist with AssetMark Trust, one of the partners that we have our third-party money managers with. So she's going to give us a broad overview of where things are at from an economic standpoint, a little bit about the markets and what we can expect for the balance of this year. Everyone is in a listen-only mode, so if you do have a question, I'd encourage you to put it in the Q&A box that's in the bottom middle of your screen. And if we don't address the questions as we go, I will pop back on at the end to ask them to Faith. So with that, I'll let things get kicked off with Faith.
Thank you, Lindsay. I appreciate the introduction. I'm actually waving at all of you. However, I believe when I started sharing the slides, it somehow disabled my camera. And so I am here in person waving at you and really want to, first of all, thank you for spending an hour of your afternoon with us today. Just wanted to go over where we're at in the current market cycle, go over an update on the economy, go over an update on the markets and how those both impact your investment portfolios. You know, I would be remiss. Here's my picture, since you you can't see my picture live. I actually did do my hair for this particular call, so it's a real shame that you can't see it. But anyway, I want to go over how we view the market and the economy, how we decide whether it's a good environment to own stocks and what kinds of stocks to own, what the outlook is for fixed income or bonds, and what are the factors that we really look at when we're deciding what companies to invest in on your behalf. And so we're going to focus a lot today on growth and inflation. Because that is how we view the big picture. We're looking through both of those lenses in terms of trying to ascertain where we're at in the market cycle. We're then going to go over markets as they stand today. We are, for those of you who don't know, in the middle of earnings season. About half of S&P 500 companies, so around 250 to 260 companies, have reported earnings. Want to give you an update on that because I think there was a lot of fear that the economy would, slow down, if not slide into recession in light of the inflation picture, and we're just not seeing that today. So want to go over, the good news there. I would be lying though if I did not say that there were some cross currents, and it's part of our job and our responsibility to be aware of what those cross currents are while the economy is growing and growing at a pretty good pace. There are some things that we are watching carefully, and will be making adjustments to your portfolio if we see play out, and I'll be touching on those as well. So let's go ahead and get started. So I want to start big picture with how we decide which companies to buy for you in your Savos portfolios. And so the first question we ask ourselves is, are we in a high growth environment or a low growth environment? So the US economy has grown, around 2% since the government has been tracking data. When the economy grows at a pace that's higher than that, stocks typically do fantastically. They typically return, over 10% annualized per year when the economy is growing above average. When the economy is slow or falling into recession, stocks typically don't do well. Companies are not earning money, and their stock prices reflect that. And so when the economy is in a low growth environment, stocks typically average losses of 3.5% on average. So that's a pretty big gap. So what we try to figure out is, okay, are we growing or are we shrinking from an economic perspective? Right now, we're going to go over the fact that we are growing. There are some warning signs, but we are in above average growth. And that's why I think stocks are up as much as they are year to date. We also care about inflation, though. Many of you on this call, including myself, don't own just stocks or just individual companies. You also own bonds in your portfolio, and that's kind of the ballast or the income lever in your portfolio, the thing that kind of controls risk, if you will. Bonds do not like high inflation regimes. Why is that? Because your bond investment, when your bond investment matures, your dollars are repaid back to you, and they're now worth less, right? You're able to buy less with them because the amount that you were earning on that loan or the interest that you were making was not exceeding the rate of inflation. So you went backwards. Bonds hate high inflation regimes. So they typically lose 2% on average when inflation runs higher than what is normal. When inflation is low, and the Federal Reserve is currently targeting 2.2%, we're running at 3%, that is considered high. Bonds, when inflation is low, typically do very well. They typically average 7.5% annualized returns in a low inflation regime. And so what that gives you is this kind of 4-box framework for not only us, but you as well, to kind of figure out, where are we in this current environment? And so what's interesting is based on historical market data, we can tell where stocks do well and where bonds do well. And we can also tell what parts of the stock market. So is it, communication services, cloud services, artificial intelligence, or is it things like toilet paper and Band-Aids and other sectors that are much more defensive that are working? But what you can see here is that within this 4-box framework, bonds go up in pretty much stocks go up in pretty much every single regime except for the low growth regime with high inflation. And that's what we saw in 2022. It also shows that, we have a couple of environments, those high inflation environments where bonds typically don't do well. Only one of these 4 different environments where both stocks and bonds go down at the same time. And so I say that because, there are some cross currents. There's some really strong tailwinds behind the economy with artificial intelligence and some other really exciting things that we're seeing. But what this shows is that the market goes up most of the time. Very few environments where stocks don't do well. There is, more risk when inflation is high to bonds, but where we think we're going is basically down into this regime of low growth and low inflation. So in 2023 and a lot of 2024, we would characterize the market regime that we were in as high growth with high inflation. Growth was running above average, and inflation was also higher than the Federal Reserve wanted, higher than any of us wanted, really. We think we're now moving down into this environment of lower growth, slower growth, and an inflation environment that is finally coming down to around what we are used to, with some caveats that I'm going to get into in a moment. This environment that we're moving into in this bottom left-hand corner is typically really good for stocks and bonds. Why is that? The Federal Reserve moves from being really constrictive with high interest rates in an effort to bring inflation down to extremely accommodative. They want to spur growth. They want to create more growth in the economy. And so what that typically does is it helps the earnings of individual companies. It brings inflation down to a level that the Fed has to stimulate, which is good for bonds. And so both stocks and bonds do well. And so we think we're moving out of this regime of extremely high growth with very high levels of inflation down into a regime of lower growth with low inflation, which is typically great for stocks and bonds. So, like I said, there are a few cross currents, however. And so what you're looking at here are two lines. The blue line is basically demand for products. So think of it as I had to get a new backpack for my laptop. Also had to get a new pair of eyeglasses. The companies that produce those goods are reflected in the blue line. And so in order to produce my backpack for my laptop or the frames for my glasses, they have to buy all this stuff in order to make the goods that they sell. What we're seeing since basically, and hopefully you can see my mouse here, we're seeing this flattening out of the companies that produce goods. They're ordering less and less stuff which they need in order to make what they sell, because they have so much inventory that they've built up as a result of dislocations because of COVID. And so, while we're not falling off a cliff by any means, while we're not near contraction, we are starting to see the companies that produce products start to slow down a bit in terms of their performance and their economic condition. The orange line are services. So I need to go get my hair cut tomorrow. That's a service. There's something going on with my right hip. It hurts really bad when I run. Got to go to the chiropractor. That is a service. Though that line is reflected in the orange. And you can see there that you're kind of seeing the same trend, this flattening out over the last year. After these huge increases as the economy came back online after COVID, things started to normalize as supply chains disruptions normalized, and now we're just kind of in this flattening out zone. So the companies that produce products, the companies that provide services, while they have slowed down in terms of their economic activity and their performance, nowhere near contraction yet. So no alarm bells going off there. Now, I know that there's a lot of lines and charts going on in this particular slide. So let's just concentrate, if we could, on the slide on the left, or the chart on the left. So I have my mouse kind of moving over it. Hopefully you can see it. This shaded huge mountain here is actually inflation. And we're going back to right before COVID. We were running at roughly, 2.5% inflation. You can see, the shutdowns in March of 2020, and then obviously inflation spiking upward as a result of the economy coming back online. Roughly 9.1 was the peak in June of 2022. This orange line is wage growth. So this is my salary, your salary, the salaries of all of us worker bees in the economy. Salaries have been growing, and they have been growing faster than inflation since March of 2023. Been growing by a pretty wide margin. This is a good thing. So this, in conjunction with all of the stimulus that was pumped into the economy as a result of COVID, has kept the economy really humming along. But inflation, the song that goes, "There's a hole in my bucket, dear Liza, dear Liza." There's a hole in the household incomes of the US consumer because of, and I hope you can see my mouse, this huge spike in 2022 had such a large cumulative effect that wages still have not caught up to where prices are. So off to the right, we are looking at the cumulative effect of prices. This is purple line is energy, so this is your gas. Green line is just basically headline inflation. The blue line that my mouse is tracking over is the cost at the grocery store. And then this orange line is wages. So yes, wages over here have outpaced inflation for the last year or so. But if you go farther back, we are still, the consumer is still underwater from an inflationary perspective because of this huge spike that we saw in 2022. So I'm going to put it in another way, and hopefully this kind of simplifies it. Let's say that you're buying gas, you're filling up your tank, and it's $3 a gallon at the tank. A year from now, a year from today, next summer, you go to fill up again, and it's now $4 a gallon. So it went from 3 to 4 in 12 months' time. So that's a 33% increase year over year. Let's say another year goes by and you go back to the pump and you fill up and it's still $4. The economists would be ecstatic because the price was flat. It basically didn't move. You still paid that $4. However, you and I are still feeling the pain of those higher prices. So inflation measures changes in price over a given time period, but it does not take into account price level. And we are all still experiencing much higher costs than we did 3 years ago, 4 years ago. And to be honest with you, wages and our cost of living has just really not caught up in terms of salaries. So I wanted to give that example because the levels of price matter too, not just the percentage changes in price, which is what everybody is talking about. We're seeing a really bifurcated consumer. And the reason why this is important is we're also seeing it with large and small companies, and I'll get to that in a moment. So off to the left, we're looking at the assets of US consumers. The top half of income earners are off to the left, bottom half of income earners are off to the right. And what it shows is how household assets are basically allocated. It shows that top half of income earners experienced 4% gain in the real estate market over the last couple of years. 45% of their household assets were in the stock market, which was up 25, 30%. And then they've got 22% in what's called other. You go over to the bottom half of income earners, and most of their assets are tied up in their home. Over half of their assets are tied up in their home. And so if real estate went up 4% and the market was up 30, and they've only got 20% of their assets exposed to that growth, it did nothing but really widen the wealth gap that we see in this country, today. So that's the asset side of the balance sheet, if you will. Over on the right side, we show how debt is affecting different income earners. Top half of income earners have only 5.6% of their overall income associated with what we call floating rate debt. Floating rate debt is a credit card. Floating rate debt is having to go to the credit union down the street to get a car loan. Just so you know, average percentage rate on credit cards now are 23% annualized. So when you have the bottom half of income earners with more than almost 3 times the amount of their income tied to really high interest loans, plus they're not making as much on the assets in their overall portfolio, you can see why why the lower income earners are starting to show signs of stress. The lower income earners have run out of stimulus money. The lower income earners are actually the spenders in this country and are responsible for a huge share of consumption. And so you can see here that while we have seen these very strong stock market returns, a lot of the country has not had exposure to those returns, and they've at the same time had exposure to high floating rate debt, some of them paying interest payments of 23% on credit card loans. We are starting to see growth and inflation expectations start to come down. And, this is, I think, a good thing. The blue line is all of the different instances going back to the middle of last year where inflation surprised everyone to the upside. Meaning We thought inflation was growing at 3%, and it came in at 3.5 or 3.8. It just kept surprising to the upside. That's this line here. We started to see inflation come in right around expectations around the beginning of this year, but then they went, kind of back up again. Inflation came in higher than expected. We have seen inflation start to surprise to the downside again, which is great. But something to kind of watch, and that expectations around inflation are starting to soften, which is a good thing. The orange line is all of the different times where GDP growth, economic growth, surprised the upside. And so while inflation was coming in much hotter than everybody thought for this entire time period, surprisingly, growth also surprised to the upside. And only until recently, until the second quarter, the start of the second quarter, early April, did we start to see economic growth estimates come in lower than what was forecasted. All of these things are actually good things, because when expectations get too high, it's harder and harder to beat them. And so when the market starts to become more realistic and starts to correct its expectations, it's easier to beat those expectations, and the market loves positive surprises. So turning to markets and what we're seeing today, we're continuing to see this domination of artificial intelligence. We have basically a market that's up, roughly 15, 16% year to date. 7 companies are responsible for probably 65% of that return. That's what we call an incredibly narrow market, not typically a sign of a healthy market. You want to see a lot of different stocks contributing to the market's advance, not just 7. So, we are starting to see some changes, though, and this is important for you to know in terms of what we look out for you on your behalf. Artificial intelligence first started within the companies that had made the strongest and biggest investment in the meta universe. So it was Meta, it was Microsoft, it was Apple, it was NVIDIA, names that you probably recognize. With artificial intelligence and with its slow adoption, we're starting to see it ripple through other sectors now. So biotech, we're starting to see it through the entertainment industry, through retail, advertising. So as AI becomes more widely adopted, we're seeing its productivity start to ripple out through these other sectors. And so the dominance of these 7 stocks that have carried the market higher for the last, 15 months is finally starting to change. And what we've seen recently, just so you know, the most up-to-date information, is a very strong rotation where market participants started to take profits in some of these names and start to look for more undervalued names in the marketplace. So selling their NVIDIA and their Apple and their Microsoft and buying small companies and parts of the market that had more attractive valuations. I say that because part of what we do on your behalf is just that. So we had some semiconductor positions in our portfolio that had grown, 300 or 400%, had gone through their price targets. We don't want to give all of those gains back. And so in some instances, we'll go in and trim that position and look for better opportunities elsewhere. But we're basically doing what I just described, what that rotation that's occurring in the marketplace that's really happening. We're kind of doing that for you on an ongoing basis, making sure that you have other things besides just artificial intelligence in the portfolio, and that we're adapting the companies you own to what we're seeing. With that being said, we're in the middle of earnings season, so I wanted to take a minute to update you on that. Chart on the left-hand side shows earnings estimate revisions, kind of a mouthful, but basically it shows a big spike here in May, and it shows a downward trend. It also shows this hookup right here where it looks like earnings revisions have stabilized. Lowered earnings estimates are good because markets like upside surprises. And so far, 78% of the companies that have reported so far have surprised to the upside this earnings season. And so that's a good thing. And so we're kind of looking for earnings revisions to stabilize. Off to the right, we're looking at 2024 growth estimates. They look very strong. They look great. Earnings are what drive markets higher. So we watch this very, very carefully. But what's interesting is when you look at the 2025 picture, which is this blue line here, you see this big decrease where the market's expectation for growth in 2025 got marked down significantly. Again, we think that's a good thing. Markets like upside surprises. If 2024 ends the way that it's been going, and we have these lowered expectations for 2025, that should set us up for opportunity and for some positive moves. So we're almost done here, and then we'll open it up to questions. And thank you for your patience. I know we're throwing a lot of charts and graphs at you, but it's been really interesting to us. And I'm looking at the chart off to the left here, how closely inflation surprises have matched treasury yields. And so what you see here is basically inflation surprising to the upside from the beginning of this year all the way through May, basically, or May of 2024. As inflation surprises, came in, treasury yields, which are the blue shaded, also rose as a reflection of that. This is the sign of a healthy market. When you started to see inflation come in below and start to surprise to the downside, yields adjusted downward. And so we're seeing, a real healthy reflection of current inflation in the 10-year or intermediate part of the treasury market. And then off to the right, one thing that you may have noticed out there, may have not, is that there are now parts of the fixed income market that are paying 9% annualized. And while that may be extremely attractive to some, there is some risk associated with that. And what we're really showing here is that bond yields and prices move inversely. This is a yield spike here that we saw in 2008. When yields spike like this, it means prices have fallen dramatically, which is an excellent time to get in. Right now, they call it spread compression. Yields are very tight, which means you are not getting compensated for the risk you're taking by buying junk bonds right now. So if you are in high yield, make sure that your manager is active, like Savos is, that they're really selective in where they're investing in the high yield market, and that they have a plan for either adding or trimming exposure, depending on what happens from here. So we covered a lot of ground. We talked about how we view the markets through the lens of both growth and inflation. We're starting to see both growth and inflation start to slow. We are nowhere near recession, but we like the trend that inflation is on. We went from, no rate cut expectations a few weeks ago to, the market's now expecting 1 or 2 cuts before the end of the year, which makes it easier for businesses to get loans and use money for investment. Long term, we see some incredible tailwinds because of artificial intelligence. This is something that's similar to the internet. It is going to have ripple effects for decades. It's very exciting to see. There's obviously some risk around it as well that we'll be watching closely. There will be winners and losers. But I think what we really wanted to emphasize is that the majority of the time stocks go up the market goes up. And so staying invested, being aware of the different risks that are out there, making sure that there's someone watching your back and watching your portfolio as different things develop is really what we're working really hard to do on your behalf. And so I'm sorry that you can't see me waving and thanking you. I have a huge smile on my face, and I'm very grateful for the time spent this afternoon. And so I'm going to go ahead and pause, Lindsey, and see if any questions came in through the chat.
Thank you, Faith. It's a lot of encouraging information, I would say, as far as where we're heading. There's still, though, some, I guess, kind of disparity between what some of the comments that the Fed has made as far as their expected rate cuts and the market pricing in multiple, 1 to 2, like you said. So is that really being driven just by the positive data that's coming out regarding inflation, or what's driving the market, I guess, kind of optimism that there'll be more than one rate cut before the end of the year?
I think it was a couple of different things. One is obviously a lot of optimism around inflation starting to surprise to the downside. So that's a good thing. But when you really think about it, if inflation is slowing, does the Fed really need to cut then? Right? The whole reason why they would cut interest rates is if inflation remains stubbornly high. And they had to basically cut rates in order to keep the economy afloat while inflation made its way down. So inflation, what I would say is what's happening now is it's buying the Fed time. It's like the perfect situation where inflation is slowly coming down, but growth is remaining resilient. And so the markets really like that type of a situation. What the market does not want to see is economic data that is becoming so negative that we're moving from a growth rate of 2.5%, 2.8% to negative. And now the Fed has to cut rates in order to spur enough growth to get us out of a recession. Markets would not want to see that, right? And so we've got this perfect situation where growth is remaining just resilient enough. Inflation is coming down enough where it buys the Fed some time. We don't have to see aggressive rate cuts in order to get us out of what looks like an economy that's coming to a grinding halt. And then I think why the market is also continuing to kind of climb higher here is, at the end of the day, the market is driven higher by companies that earn money. And so we are still seeing companies earning money, and we're seeing earnings growing at double-digit rates. And so that's another reason why there's this kind of disconnect between, I would say what the headlines are and what the actual data is showing. And so the actual data is still pointing to a pretty healthy, strong economy, strong consumer. But there is signs that like we talked about, those lower income earning households are starting to feel the stress. And so, those are kind of the things that the market looks at. I think all in all, though, it keeps trudging higher because companies are still making money. Does that make sense? Or
Yeah, and that's an interesting thing to circle back to as well, this bifurcated consumer and rising debt levels. Is there a threshold that, I mean, what are we really monitoring for there? I think we hear about it a lot to say, that we know that consumer debt is rising, but are there, what's kind of the threshold where we really start to feel like that's an alarm going off or a bigger concern?
Yeah, that's a good question. And a threshold is something that I don't have off the top of my head. We've been surprised by the strength of the economy because of the consumer. One thing that I think we all forget is that after COVID, through monetary, that is the Federal Reserve, and fiscal, that is Congress, They basically shoved $9 trillion worth of stimulus into the economy in a very short amount of time, and that took years to work its way through. We've now seen that run out of those bottom income earners. And so now we're really watching, okay, so they've been okay because their wages have outpaced the rate of inflation. They've got some cushion there. They had some cushion from this COVID stimulus, which is now gone. When we start to see wages fall below the pace of inflation is when I think we will become very concerned. We did see that for quite a while, and that's why a lot of consumers are still in a hole. But I think typically when it comes to the percentage of income that is associated with floating rate debt, so that would be the chart off to the right, when we start to see it in the 15 to 18% range is typically when the stress is so great that it hampers spending. And we're already starting to see that a little bit where people aren't going to buy the new washing machine this year. Maybe they'll kick that can down the road. Some of these bigger discretionary items are starting to slow down a bit. And that could be because, there's a higher percentage of overall debt at very high rates now. And it's absorbing a lot of their disposable income. But typically based on history, and again, we haven't seen credit card rates at this level ever, maybe the 80s. I didn't have a credit card then, but basically when we get to that 18, to kind of 20% range is typically a time where it gets pretty, it impacts consumer spending and consumption, which is an important part of growth.
When we think about AI and the exuberance around that, the question came in about, is there belief that it's actually going to increase productivity, or is it a hope that it's going to actually reduce labor costs?
I think it's both. I think, that there's pros and cons to this. And so the pros are obviously the productivity gains. One could argue the same for the internet, right? I remember when I was first starting out in the field, I had to print out maps through MapQuest. You guys remember MapQuest? For the offices that I would go and visit in the middle of Mississippi. And I would have this folder of all these printouts of how to get from my hotel to the different places that I needed to go. And God forbid there was a detour or something that got in my way because I didn't have GPS at my fingertips at the time. And yes, that might have displaced some jobs, but the productivity gains that we saw as a result of the internet cannot be disputed. It's going to be the same thing with AI. It's going to be extremely painful in that it will replace a lot of our jobs. I think that there is a real risk that a large part of our population will have to be subsidized because of this emerging technology. In other words, support from the government in order to survive because their skill set didn't keep up with innovation and technology. I do think that the adoption, like we're kind of adopting it here at our firm at Savos in terms of how we research companies, how we make changes to portfolios. There's a lot more we can do a lot more quickly. And I think what it will cause all of us to do that are in the field, and I'm using this as an example, is to sharpen our skills. How do we use AI to stay relevant and to make sure that we're also keeping up with what it's able to do and the technology gains and the skills that are required to use it correctly. And so what I think what's happening is all these different industries are sharpening their axes and trying to figure out how to use AI in a responsible way, and then also get their staff up to speed on what it means and how to harness it. But I'm not going to lie to you. I think that there's going to be pain. It will be productivity gains because of jobs eliminated, but also because of making, I think, workers even sharper and better and faster than they are today. And that, there's still a human element to a lot that we do that's required. But if we can make the way that we retrieve data, analyze it, and use it more effective, and I think it's a good thing. So I think it's both. I honestly think it's both.
I heard another speaker recently say that, if it's able to make some of our mundane tasks that we do executed more quickly, then that frees up time for us to do a lot more bigger thinking and kind of focus on bigger problems. And so that's an area where it's really going to be able to help increase productivity by eliminating some of the time consuming aspects of some of our day-to-day jobs.
Absolutely. Absolutely. I mean, think about some of the administrative stuff that we have to write or that we have to do, the proposals that we sometimes have to generate, having things like ChatGPT at our fingertips to help with those templates and those things. And then we go in and just add the finer touches to them, I think will make us so much more productive. So it's going to be really exciting to see. And, I constantly ask myself, I don't know if you guys have read Sapiens. It's an interesting look at the human race and where AI is going. But there's some really cool things happening in the biotech space, in the healthcare space. So, it's not just cloud computing and chat GPT. There's some really neat things that AI could promote. So I'm excited to see where it goes. Nervous, but excited at the same time.
Yeah, I'd agree. We're definitely still in early stages of what capabilities that it will bring. Another question that came in is maybe a little bit more philosophical, but it's is what's good for the market good for the general economy and wage earners?
Is what's good for the market good for the economy and wage earners? I think it's more complex than that. I think that what's maybe starting bottom up, what's good for consumers, what's good for employees that serve those consumers, and what makes it easy for businesses to interact, engage, and do business with their end users is what drives earnings. And what earnings are what basically cause prices to go up or down. And so if you start from the bottom up, employees and users, making it easy for businesses to operate, which means, lower interest rates and things like that, lower costs of capital and costs of doing business. That, in turn drives earnings. Earnings drives stock prices. Prices going up are good for markets and are good for investors. It's a positive reinforcement loop. And from there, it's good for the economy. But I would say that it's a little bit more complex than that, in that the economy is basically 70% of it is consumption of the consumer. And so if the consumer is unhealthy, but the market's going up because AI is doing great, but the consumer is riddled with high interest debt and all their stimulus money has run out and they're unable to go and buy the washing machine, that's going to end up having crippling effects on the economy. So I would say it's bottom up. I would say that what's good for market participants and consumers is good for companies, which is good for the economy, and so on and so forth, if that makes sense.
Another thing I'd add there is that the markets are forward looking. So one of the slides we talked about was that, inflation might be coming down, but us as consumers are still feeling the pressure of higher costs. And so there's a gap that exists there that we haven't quite worked our way through.
Yeah.
And so some of the positive market returns that we're seeing feel like it's disconnected to us in our everyday life, because we're still feeling some of the pressure at our daily spending at the grocery store, or that example that you gave of gas prices. And so I would just add that with the market being a forward looking indicator that, better times are on the horizon doesn't mean that we're in them right now.
That's true. That's true. I would,
Uh,
I would agree.
And so that's probably a good way to segue into talking about the election cycle, the connection being a disconnect between, what we feel in our daily lives and what the market might be doing. Could you give an overview of Savos' view on the expectation of the election's impact on the market and the economy?
Yeah, wow, what a crazy couple of weeks. I was on vacation week before last and was walking through the lobby of the hotel I was staying at when I overheard people excitedly talking about an assassination attempt of Donald Trump. And I was shocked because I remember as a little kid the Reagan assassination attempt and how it like really shocked my parents. And so was like really confused about one, how it could happen, and then two, like, holy cow. And then from there, I had this feeling like, wow, I wonder if this will create support and more interest in the election itself because of this assassination attempt. And lo and behold, it did seem that occurred. I we then had we had the debate, and I thought it was much like a Saturday Night Live skit. I don't care what side of the aisle you're on, the entertainment factor was like through the roof. If it weren't happening to us, it would be hilarious. However, from that came major changes to the Democratic Party, and so I was laughing with Lindsey prior to this call, talking about how we had a slide that had basically the Biden platform and the Trump platform, and kind of a side by side of the two. And we had to quickly remove that because the day it was going through compliance, Biden had decided to drop out of the race. Again, kind of invigorating interest in the electoral process, in the election itself. Up until that point, I just felt like it was this, like, I don't know, people were not that excited about either candidate. And so I think there's more excitement in both candidates now. And I think that, to be really honest with you, we could care less. The reason for that is, at the end of the day, when you look at how markets react throughout history to either a red or a blue, kind of government, the difference in returns, the difference in inflation, the difference in GDP growth is like it's so small, it doesn't even matter. What matters is, whether or not you think the country is going in the right direction, or whether or not, we are putting our best foot forward in the global picture. All of that stuff is important to us, but it's not necessarily important to the market. And the reason why I say that is what I said before. All the market cares about is this company growing? Are their earnings growing? Is their stock price going up? If there's something in the world that affects that, the stock price will reflect it. But the market could care less about whether it's Trump or Harris. It really couldn't. You and I might. But whether a company does well or doesn't do well, it doesn't make a huge difference. And so, yeah, obviously, some candidates are more pro-business, some are not. That will have an impact to some degree. But when you kind of look at history and you look at, okay, is it better to have a red or a blue guy or girl in there? It really doesn't make that big of a difference. So all we do is put our blinders on, put our head down, and look at the data and follow the data and follow what these companies are doing, how their earnings look, how their balance sheet looks, what their management teams are saying, what their free cash flow looks like. Are they healthy? Are they strong enough to, weather any sort of economic slowdown? That's the kind of stuff that matters to underlying stock prices, and that's what matters to our end clients, and whether or not their portfolios do well. So that's a rude kind of way of saying like we kind of don't care. But I mean, at the end of the day, obviously we do. We all have a personal interest in the direction of the country. But when it comes to stocks and bonds, what matters are companies' earnings and their ability to keep the lights on at the end of the day.
So given that that's really kind of the, an institutional perspective, how would you anticipate the everyday investor to navigate the next few months as we go through an election cycle?
Yeah, I think it's going to be a bit of a little bit of a circus. I do. I think there will be some volatility for a couple of reasons. One is we are starting to see major rotations happening in the market. Kind of talked on about them earlier, where we're starting to see small businesses, small cap stocks. So these are the smaller companies in the market start to take off. Which typically you see when the market is anticipating strong growth and lower interest rates. You're seeing a rotation away from the Magnificent Seven. Investors are now interested in companies that have a little bit more attractive valuations. We're also obviously looking at an election where, there's going to be a lot of back and forth between candidates. We're still in the middle of two world wars. And so I do anticipate, volatility. You typically do see a lot more volatility when there's a big rotation happening in the market, which we're seeing. Typically, you do see volatility around elections, but at the end of the day, market will do what it's going to do, but it will definitely move up a little bit more than it normally does, as headline risk is high with different election related headlines. So yeah, I think we need to be ready for a bumpy ride. If it doesn't happen, fine. But what we're trying to do on your behalf is, if we start to see something really unexpected happen to some of the companies we own and that we like and that we've carefully researched, we've got a buy list on standby that we're ready to kind of move into if we like something better, for a better valuation, a stronger balance sheet, a stronger management position, or whatever the case may be. It's our job to kind of adapt the portfolio to what we see happening. And I think that we will see some volatility. I don't think this AI theme is going away, although I do think it's broadening out, which is great. But it's really nice to see other parts of the market starting to participate in this strong advance now. And that's typically a sign of a healthy market.
Well, Faith, I want to thank you for all of your insight and comments. It's like I said at the beginning, it sounds like there's some encouraging information out there, but as you just noted, could be a bumpy ride as we get through the rest of 2024 with the election on the horizon, and also waiting for to see what the Fed does with interest rates, as the market is pricing in, 1 to 2 rate cuts. So it'll be interesting once we get to the end of this year, and hopefully have 2025 be a little bit more of a stable year, as opposed to the past couple of years where we've really seen a lot of different market cycles that we've lived through. So thank you again for joining us today. I want to thank everyone else that was on the call as well. Thank you for your questions. It's always seems to be timely when we have these economic updates. So we will look forward to our next one that will be coming in the fall, and we'll be a lot closer to the election being over then, and I'm sure a lot more to talk about. So with that, I hope that everyone has a great afternoon, and thank you again for joining.
Thank you.
Thanks, Faith. Bye-bye.
Thank you.